For more, let's bring in Barry Knapp of Ironsides Macroeconomics. Barry, it's great to see you. I didn't realize you were so dovish. Is this a recent thing?
Well, yeah, I've been pushing back on the Fed really since the Silicon Valley Bank collapse.
True.
And, you know, you and Dom were just talking about the Treasury curve. And, you know, there's lots of discussions about the Treasury curve inversion and how long before it triggers or signals a recession and the like. But I think we have to step back, as Dom just intimated. This is really an exceptionally deep inversion, right? So there were inversions greater than 1% on a monthly basis in October of 73, right before that giant recession from 73 to 75. There was an inversion of 100 and, almost 200 basis points in December of 79, and then another one in December of 80. We've never had anything even greater than 50 basis points. And I'm measuring it by the 3-month bill against 10-year Treasury, because the 2-year Treasury hasn't always been around, but that sort of represents bank financing. So this level of inversion is extreme, and it was followed by, very bad outcomes, very deep recessions. And in the case of 79 and 80, it set off a chain of events that led to the thrift or savings and loan industry ultimately collapsing. And at the time, that was 80% of mortgage credit supply. So, we're playing with fire here. And when I look through the data, I see credit growth continuing to deteriorate. Commercial and industrial loans from small banks is down to 0% growth and likely headed more negative. And I saw a lot of evidence in that labor data last week that small business employment is deteriorating as well.
Yeah.
That's the most opaque but largest portion of the employment market. And it'll be one of those things that just sneaks up on the Fed and hits them over the bridge of that nose with a ball-peen hammer, so to speak.
I absolutely share your concerns, Barry. One of the pushbacks that I hear, maybe you can address it, is from people who say, well, this isn't about the banking system, or to put it differently, no one's going to cry for the banks, right? Okay, so they were mismanaged, they got into trouble, what have you. To me, I'm still scarred by the financial crisis, but they say, well, maybe this isn't the financial crisis. And so if there needs to be, some pain felt by the banks, the Fed's larger fight and more important battle is against inflation. What would your response be to that?
Well, I have a little PTSD around financial crises as well, having been a partner, senior managing director at Lehman Brothers. So right. I readily admit to seeing financial crises at every turn. But listen, the banking system, this isn't about mismanagement. The hedge for interest rate risk for the banks is cheap deposits. As I said before, having the curve inversions last for more than a month or two is extremely rare. They don't hedge interest rate risk. They get cheap deposits and the curve carries positively and they're able to lend money. If we do truly have higher for longer and keep the yield curve inverted for a year or more, the banking system won't be able to supply any credit. And therein lies the real problem. And it's not just the rate hikes. It's the fact that the Fed owns a third of the Treasury, mortgage, and TIPS market and is suppressing long-term rates.
Yes.
So it's not even allowing the banks to earn their way out of the third of their assets that they hold in government securities. And furthermore, the inflation argument, to me, just strikes me as kind of silly at this point. We're going to be at 3 on Wednesday on the headline, all items inflation. And then the core is going to decline between now and the first quarter of 2023, regardless of what happens. It's because of the goofy lag-impaired shelter measures that are going to be putting downward pressure on inflation. And Powell's, core, super core services, less rent of shelter, that peaked in September of last year. And that's coming down as well. We had a 0 in that last month. So I don't even understand the discussion about inflation. It's going to go to 3. It's going to stay there for a while. And we won't know until the second quarter of next year whether they have any chance of getting it to 2. Personally, I don't think they do, but I don't think that's important either. If it's stable at 3, that's more than sufficient.
That's interesting, because that's what I was going to ask. So let me just leave it as this. So for those who say, all right, well, fine, Barry or Kelly or whoever might have had them, pause rate hikes back in March, but look at the payroll data. And can you imagine how strong the economy would be if they weren't still, pushing policy into more restrictive territory? What do you think about that?
That we're in recession. We've had 2 quarters in a row of negative GDI. Income is what matters, not the government's feeble attempts to add up the sum total of all the widgets and services we produce. The net operating surplus of the private sector has been negative 3 quarters in a row. Government spending in the GDP accounts has been really positive 3 quarters in a row, 4 to 5%. So this to me is not a really good mix.